Good afternoon, everybody. Thanks for joining us in today's video. We have Andrew Carnes from Chip Reverse Mortgage. Today, we're going to be answering a lot of the questions that you've given to me over the last year. You've been asking me, hey, David, does a reverse mortgage make sense for us instead of selling the house? Could you do a video about that? So today, we've got an expert going to help us understand reverse mortgages. Now, full disclosure, I have not been compensated for this from Reverse Mortgage or any reverse mortgage company. I approached Andrew because we had a really great session for advisors to learn about reverse mortgage. And I said, Andrew, this is the kind of material that my YouTube followers have been asking about. So would you be generous enough to come on? So welcome, Andrew, and thanks for joining me today.
Yeah, thank you very much, David. I've had the chance to go through your channel. I've just so impressed by the nature of the full transparency of information you provide, and that's my goal professionally here representing Home Equity Bank and the Chip Reverse Mortgage Program, is to make sure that the public has the facts about where the solution might fit for them. Our most recent surveys show that 93% of those over the age of 55 intend or prefer to stay in the home that they love. And you hit the nail on the head here. It's really about a connection to the community. More often than not, in my experience, you have multiple family members with homes in the same area. And the other major factor that you also said is a downsizing maneuver that was traditionally thought of back in the day. Now you can't capture the same level of value. So the amount of money that might be freed up through the sale of one's primary home, isn't yielding a net increase in the style of living. That's really what it comes down to. So when people discover that, their home can be used as a store of value, that significant improvements can be made to the home, and opening up people's mind to what those improvements might look like. Maybe it's a renovation of a kitchen, a ground floor bathroom, as an example, is a very popular renovation that our clientele use their funds for. It, number one, adds value. It protects the integrity, the health of our clients, and it keeps them happy, right?
Yeah.
So it's very important. One of the things that we find is that there's a hangover, if you may, from south of the border, where there are different features tied to reverse mortgages versus the Canadian experience. Hey, listen, Canadians are a conservative bunch, right? Mm-hmm. And, one of the more interesting things about reverse mortgages is it's not an all or nothing decision. When you hear our commercials up to 55% of the market value of the home, it's very rare, in fact, that clients actually take out that enough. They just want to take enough to make themselves comfortable. So, you can well imagine, in greater Toronto area and major metropolitan areas across the country, we see with $1 million house, some of our clients might be able to qualify for $500,000 or more, but they don't need $500,000. They need $100,000 to pay out a home equity line of credit that they already open at the bank. This is a very, very easy transition. So the reverse mortgage advantage, and if you can go to that slide, I'll point some of these out. The most important thing to mention, David, is that from a legal standpoint, a reverse mortgage is not dissimilar to the conventional mortgage or home equity line of credit that clients already have had or had in the past. It is simply what we call a first charge against the client's home, but it offers a few more features than a conventional loan or a line of credit, and the biggest being that there is no payments to maintain. So the average situation that I find, with the clientele that I deal with is, perhaps they have used a home equity line, or they have a little bit of outstanding balance going into retirement, let's say $200,000. The existing payments that older clientele have that are, that cash flow is really hurting them. It's not unheard of to see, some of these people that are into retirement wrestling with, payments of $14,000, $15,000 a year, as an example, on a home equity line of credit, that they have to find that cash out of limited resources. So most of the reverse mortgage work that is done for us is a conversion from one type of home equity loan to our type, the CHIP reverse mortgage program, essentially an exchange or a swap. And so they're already used to it. But the benefit of no payments is very, very significant. David, one of the things that you brought up when we spoke earlier, you talked about 55%. And I wanted to disclose to our retired or better generation people come in a variety of different ages. So not every clientele qualifies for 55% of the value of their home. It's like a seesaw, actually, in a way, in that the younger that a retiree is, so let's say 55 years of age, they qualify for less CHIP reverse mortgage money than somebody, let's say, that's 82 or 83 that would qualify for more. And that's just common sense. An 83-year-old is likely going to stay in their home a little bit less than somebody that's 55 years of age. So we bias the amount of money that we can lend to somebody based on their age, but they're free of that obligation to make a payment for all the time that they spend in their house. There is no obligation to make a payment. So, one of the things that we often talk about at the kitchen counter is, like, we look at, a shed in the back or the living room, and we say, well, you can't sell the living room off in order to raise funds. You need a tool to access that money. And it doesn't mean that you have to take all the money that you qualify for. You just take what it is that you need in order to make your retirement more comfortable. One of the other things about reverse mortgages, like Home Equity Bank, we've been at it for 36 years plus. And that's all we do is reverse mortgages. And often we're asked, well, aren't these reverse mortgages expensive? And, we're at this very interesting phase right now where, in fact, maybe you can show up a slide here, the home equity lines of credit, the next slide, the home equity lines of credit actually have a variable interest rate cost that's higher than the fixed cost of a CHIP reverse mortgage. Plus, a reverse mortgage, as a way of a benefit, has no payment obligations. And it brings up a couple of topics that if somebody of a better generation is maintaining these lines of credit, and the illustration I have here is watching a line of credit almost more than double the monthly cost. And that's a real challenge that a lot of the better generation are wrestling with right now. You can convert to a situation at a lower cost with a reverse mortgage than a home equity line right now that has no payments. But interestingly, one of the mythologies is that the better generation can actually make payments on reverse mortgages. A lot of people don't know that. So if there is a degree of comfort or cash flow benefit that somebody has coming in, and they elect to pay the interest cost, even on a reverse mortgage, they can do that. In this example, the cost $17,000 could be, if somebody has the cash flow, they can do that. In fact, they can customize the cash flow. If David, as an example, the couple only had $100 a month to redirect towards the payment on a reverse mortgage, they don't have to make a payment, but if they elected to, they can do that. Oh, do you have $200? Great, you can taper it up all the way up to the interest cost. And this is particularly valuable. Interestingly, just before we start, I was dealing with a couple where one has retired and the other one is not retired yet. So there is definitely employment income to maintain it, but they just want to reorient themselves into a position where they don't have the huge monthly payment. So they can still afford to make some degree of payment. So we work flexibly, and this is where the customization or the tailoring of a reverse mortgage becomes very important, to work across the table with a professional, because we can do that. And to take it one step further, when there is full retirement in that household, then we can just shut off those payments, and the couple has the benefit of the reverse mortgage for as long as they stay in the house.
So in case of like parents who wanted to help their children with down payment, then they could, and depending on the children's financial state of affairs, they could say to the children, like, they don't have to cover the full interest cost of that year. They could just say, look, is $500 a month good for you? is $250 a month. So get them paying something, so they're used to paying debt and servicing obligations, but not to the point or to the extent that it's crushing them and they're not able to do things. So
Yeah.
such a valuable tool for parents here, or
Yeah.
even grandparents for that matter, if they wanted to do that and help out their grandchildren. That's a
Well, sure.
possibility as well, right?
Yeah, like anecdotally, I've been involved with sending several Canadian grandchildren to medical school in the United States because there just is not the funds available through the parents, but the grandparents
Right.
have it. And they have an important choice. Do they sell off the income producing investments, or do they unwind a pension or something of that nature? No, 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 no. Look at the best performing investment you've had. It's likely your house. Here's a way in order to get that cash flow to perhaps grandchildren, in order to take care of business. And that's a possibility. We've seen that for people starting up businesses, as an example. We've seen it through where, children have gone through divorces, there's a need to acquire a condominium and they need $100,000 down payment. And yeah, absolutely, David, like they have every intent to pay it back. Great, wonderful. Then let's use the reverse mortgage on a more semi-temporary basis. I'm going to say that in order to provide for the cash flow. There's lots of equity in mom and dad's house. So there's no limit to the creativity that our clients have on how to use cash.
Love it.
And it's tax-free. That's another interesting thing that we didn't talk about, is the advances that come out of a reverse mortgage are a tax-free event. So, if somebody had sort of a choice, they had said, "Oh, I'm going to cash out something, but it's going to give rise to the redemption of a registered asset that is sort of counted into income, or a capital gains if I sell it," it may be a better choice to take an advance, even though it's a reverse mortgage loan. It may be a cheaper alternative to take it out that way, knowing that the cash flow is tax free. That's an important consideration.
Let's say a couple who are interested in purchasing a property in Florida, like a condo,
sure,
for instance,
yeah.
And they know that they don't have to make any payments, so they can pick up. Let's say the property is a good value because of whatever economic conditions that are in, and they're saying this would be the best time. We've got a dip in the market, so let's use our home. Let's use the home equity that we've got to purchase. So they can come to you. They can. Is there any restriction from taking capital from their home in Canada and being able to use that money to purchase a property in Florida, for instance?
Absolutely none. So the reverse mortgage is always on the primary home. So what is done with the funds that are derived from reverse mortgage of the client's choice? Gift it, purchase property. You talked about a U.S. example. That's fine. Sadly, we can't involve U.S. property in a reverse mortgage, but as long as a Canadian domicile primary residence in Canada, they can use the funds for any purpose that they.
Man, I'm liking this. I'm liking these options for people.
Yeah.
Okay, let's see this. This was a great slide as well. Could you speak to this one?
Yeah, this comes. Remember, often the first question out of a family's meeting is they want to ask what are the rates of a reverse mortgage. Currently, as an example, is the 5-year rate is just actually in the last couple of days gone to 6.89, not the 6.99 that you see on the screen. But more importantly, is not the rate, is the spread between conventional mortgage rates and CHIP reverse mortgage rates, is they've compressed significantly over time. There's a number of reasons for that. We're a larger Canadian bank. We're owned by Ontario Teachers Pension Fund, as an example. So we're able to pass along a significant amount of the, I'm going to say, the savings or our acquisition of capital, so that we can become even more competitive. But it is important to understand that, when people say a reverse mortgage is expensive, well, compared to what? A conventional mortgage has that monthly obligation to make principal and interest payments. So if the cash flow is creating a real problem for a retired couple's lifestyle, then the value of having no payments costs something. And that's one of the features of a reverse mortgage.
I love it. I love it.
Oh yeah, you know what? Actually, I just saw this slide come up here, David. You talked about the down payment. This is big. This is happening to us big time right now. Um, and let me paint a picture of what's happening in the real estate market. So in the GTA, we've seen an overall decline in values, and that's not frightening. That's actually can present some significant opportunities. And it's a relatively short period of time that we've seen a little bit of a dip. It's about 18% in the GTA, but it's disproportionately affected condominiums greater than single family homes. So knowing that mom and dad likely have a beautiful home that they would like to preserve and stay and enjoy, that then what can be done in order to help out the next generation. And the slide that you brought up there is an example. I just chose one from Mississauga that recently happened with us involving a $1.3 million home that was owned by a widower. And the daughter was in need of $100,000 in order, $200,000 actually, to find as a down payment in order to qualify for a conventional loan. And the reason is because the condominiums are a much better value than they were this time last year, type of thing. But you know, there's always this consideration, and I need to address it. It's sort of an elephant in the room. Is what happens if you have more than one child, right? So you know, if daughter needs $200,000, what about the son? So, you know, the conversation that's happening now is about pre-gifting, right? Pre-inheritance, if you may. So a reverse mortgage has this interesting ability to take care of a point-in-time need for the daughter's real estate down payment. Like she has a job and she can afford it. But perhaps maybe the son is wrestling with a higher mortgage balance and maybe they want to pay it down. It is essentially giving a portion of the estate to both daughter and son at the same time in order to help everybody have a better cash circumstance. And so why not to have that discussion if it makes financial sense for the entire family? You brought up the example that perhaps maybe there might be some willingness for the next generation to pay mom and dad back. There's opportunities to do that too, even within a reverse mortgage. So, you know, it's just, you know, sort of like that arrow in the quiver, just one more tool that a lot of people aren't aware of. Yeah,
this is an example of a gentleman in Mississauga.
Yeah, in Mississauga, right? And you know, here we've found over $500,000 with the chip reverse mortgage money that we can provide. The details don't require them to take $500,000. It's just essentially, you know, the maximum amount that they would qualify for, and that's worth discussing. So let's say, for example, that the $200,000 down payment on the condominium for the daughter is the only amount. Remember, if this client got a fire alarm test, can you believe it, David?
Nice. It happens. You know, Andrew, it's fine. You know, I get ambulances and fire trucks every now and then because it proves that we're not AI characters. We're real life people sharing great information with everybody.
I know. But just to pick up again, you know, somebody qualifies for over $500,000 of chip reverse mortgage money. If they only have to take out $200,000, then great. But the more interesting question, though, David, is what happens if I qualify for $500,000? I take out $200,000, less than what I qualify for. What about the $300,000? This is important. When a reverse mortgage is set up, it's sort of a once and done solution. Mm-hmm. And the $300,000 that is not taken, obviously there's no cost to that, but it remains available to the client for as long as they stay in their home. So, this is important because a lot of people use this sort of as a emergency reserve is a better way to think of it. So again, there's no obligation to take out the full amount. You just take out what it is that you need. But imagine being able to pick up a telephone call and say, deposit $300,000, to my account. I bought a cottage 5 years from now, or whatever the case is. It's a world of flexibility that does not exist in current conventional banking. The greatest example that I have, I tell a story from time to time, is I was working with a retired dentist in Etobicoke, and very expensive house, qualified for $1 million. And then when essentially the paperwork was done, the dentist only took out $25,000, a 70-year-old. And we were like, well, why are you doing this? You have lots of investments. And, he turned to me, I'm about age to qualify for a chip reverse mortgage, but he called me son. And he said, son, the reason I'm doing this is because I know your feature is that, I can call on $975,000 10 years from now if I need it. So I'm putting this into place because I no longer qualify for insurance. Mm-hmm. And, we have a number of people like that, they're not worried. They're actually less worried, less stressed, because they know that they have this reserve, call it a healthcare reserve or emergency fund reserve or a fund reserve, for ideas that they have in their head. They can actually get this working for them, but have it permanently, at least as long as they stay in their house, permanently in effect for as long as they live there. So the dentist only took out $25,000, but literally a phone call away on 3 days business notice can call up a very significant, powerful amount of money should the need arise in the future.
More than half of the population retire at an age where they didn't expect to retire because of an illness, by the way. And about a quarter of the population retire earlier because they have to support a family member that's ill or disabled or not able to go to work. And so one of the things that I've seen over the years, many times, and sadly, but many times, and that is someone who is on long-term disability. They've gotten ill, maybe it's cancer, and they're not able to go back to work. Mm-hmm. And the other problem is, at a certain point in their life, they're going to be terminated from their employment at usually age 65. Yeah. And they no longer can qualify for traditional lending products because they don't have an income.
That's right.
And this is where reverse mortgage, that being able to qualify for a certain amount of money to be able to support them through their lifetime is going to be very useful.
Yeah, like there's a technical term for it. We're as close as it comes to equity-only lending, meaning that the amount that a person qualifies for is not based on their current income. We've had situations where in fact, individuals, have very close to zero income declared because of their businesses and things like this. But yet they qualify based on their age and the value of their home. So it's a unique place in Canadian banking that we occupy. There's so many buttons that a client can press depending on their level of sophistication, in order to activate that money to do their bidding and do good things for their family. There's so many applications. Well, one of the ones you brought up, which I think there might be a slide. We don't have to show a slide, but it is worth mentioning, since coming out of COVID pandemic circumstances, is sadly, some couples have called it quits. They've become separated. They've said enough is enough. The children have left the home, and they want to go separately. And this is a huge financial burden on the retired public, like in terms of how people settle with each other with these homes that they've built as a couple for a long period of time. And normally there's one individual in a separated couple that wants to stay in their home, and somebody that wants to get out of there. And that might be involved in collapsing important stuff like pensions and investments, big taxable gains, all these sort of issues. But if you remember, we talked about the advances from a reverse mortgage are a tax-free event. So if indeed one person would like to stay in that house and we can generate enough money to pay out the other spouse, perhaps there might be a shortfall, but that's okay. We have the ability to keep the one that wants to stay in the house to stay there free of any payments whatsoever, continue enjoying the property, continue enjoying the appreciation potential of the property, right? Sometimes markets go up more than 2 or 3%. Sometimes they go higher. This could actually be a really good equation for two separating clients, especially one that needs to acquire a new home, as an example. So it was interesting that we very rarely saw this, but it's really starting to come on strong, and we've become very quickly experts in this field of we call it gray divorce.
If someone has their home paid off and they choose to rent their house, for a number of months per year. Does that have, is it completely disconnected doing a reverse mortgage? They're doing whatever they want with their equity in their home, even though they might have tenants living in the basement?
Yeah, every situation is unique. The most important thing is some of the conditions of the reverse mortgage, and they're pretty simple. Is you have to pay your property tax, you have to pay your insurance, and you have to be a permanent resident of that home, right? And yes, there's movement to allow people to go to Florida for a couple months, so on and so forth. But renting out the entire home would not be applicable to a reverse mortgage situation. We definitely do have situations with tenants in the basement that can be accommodated for. But if somebody has to reside at that home, and not to take it too much further, but one of the circumstances that you hinted at earlier is a real life one. Is husband and wife occupy the home, they undertake a reverse mortgage. That's great, but 4 or 5 years down the road, find out that one of them has to go into long-term care, right? So somebody is no longer at the home, and it's not possible for the other spouse to move in together with that. And that home care, or sorry, the long-term care can be very expensive, $50,000, $60,000, $70,000, $80,000 a year, perhaps, right? So where's that money going to come from? Well, at the same time, somebody else needs housing, right? So, we'd like to think that a chip reverse mortgage could be part of a healthcare reserve where the spouses can no longer be together. That's fine. And the reason we do that is then when a reverse mortgage is created, it's always done on both lives. So whether or not one is with us, down the road, that's fine. The reverse mortgage continues intact until the final spouse is no longer in the home, and that's when the reverse mortgage becomes due. And we can talk about that too. What are the downsides? It sounds so good, and it is good, and there actually is very little downsides. But there are some areas where a reverse mortgage does not fit, and where it does fit. So what I like to concentrate more on where it doesn't fit. And one of the ones is where there's a really high income being earned. So as an example, a high net worth individual has a very high current income and whatnot. There may be credit available conventionally that might be lower cost and better deal for the family. That could be possible. So in that circumstance, we'll very quickly step in and say, we belong in this equation or we don't belong in this equation. One of the other ones, and this, sort of goes to what I just talked about, is the qualification age. We can qualify an individual that's age 55 years of age and older, but because we do it on spouses, both spouses must be at least over the age of 55. Sometimes we meet, an individual that's in their 70s, but they're married to a 45-year-old. That happens. Right. They sadly will not qualify for a reverse mortgage. And the reason is because the language or the agreement in a reverse mortgage is that reverse mortgage is in place for the lives of both people, so that there's no payments, no need to move for the life of both spouses. So both clients must qualify. But if you consider that other thing that we talked about, that a younger person qualifies for less money than an older person. I'll give you some math here. So let's say a detached home in the major metropolitan marketplace. You have a 55-year-old single individual. They may qualify for approximately 20% of the value of the home, sometimes as high as 23%, depending on the type of home and location. But an 83-year-old would qualify for 55%. There's a big band, a big difference between the two. So if you have a spousal situation where one spouse is younger, but they have the right to stay there, well, their younger age is going to bias that calculation. So even though the other spouse is older, we might not be able to get the amount of money that the couple needs. So, it's my job to make sure that the couple knows this and to find out if the smaller amount of money that's limited by the younger spouse is known, and to make sure that we can get the job done. Sometimes we can, sometimes we can't. The other thing I was going to talk about is, large debt loads. And again, earlier this morning, I went through a circumstance where somebody was, basically asking their financial advisor, can I retire, right? Age 54, about to turn 65 with a full pension. And what we discovered is that their $1 million house had $500,000 owing on it. Well, because 64, 65 is relatively young in the equation of how much we can lend, we can't lend enough money to cover off the existing debts. So we must be in first position. So we have to take over an existing mortgage or home equity line. And if there's a shortfall, then maybe it might be better for them to keep the conventional loan and continue, sadly, making those payments until such time that maybe they're a little bit older, or their existing conventional loans have been paid down a little bit, and then we match at some point in the future. So that's a conversation that we have all the time.
I'll show you one slide here that comes to mind. It's full screen there, but this is really around early retirement. And you think about someone who, as you just mentioned, let's say they're a teacher or government worker, and they've got a pension, defined benefit pension, so they're going to retire early, let's say, but there might be a gap here between when they start receiving their full pension or CPP or old age security at age 65. So let's say those two red bars represent a gap here of income.
Yeah.
So what happens usually is you get somebody that might have very low tax-free savings account values and either zero or very low non-registered values, and then a much larger RSP, and then they've got a pension. So they have this 2-year gap where they have no ability to fund those 2 years.
Yeah.
So the reverse mortgage comes into play there, where they could say, look, we can use a reverse mortgage to fill in that gap prior to receiving all of the pension. Would that be a viable scenario?
It's an excellent idea, David. And I'll just put a little more icing on the cake there is usually if they are forced to sell something, cash out of those RSPs as an example, there'll be a taxable disposition that has some potential effects on, the net cash flow. So a reverse mortgage definitely will fit because it's is a tax-free event. So even if it's, call it a more temporary cash flow buffer, if you may, then they have that. And then when their pension kicks in, there is even flexibility to pay back a portion of a reverse mortgage over time or the interest cost of it. So yeah, definitely the reverse mortgage can occupy a more temporary need or a longer term need. My general advice would just keep it, just keep the reverse mortgage in effect. And the reason I would suggest that often is because the longer that you can leave your investments in place, there's a natural tendency for those investments to increase in value, but concurrently the home increase in value. So it doesn't pay to downsize. So the reverse mortgage, shouldn't be, looked at as it's a mortgage. It should be looked at, it's a tool in order to maximize cash flow. That's a better way to think about where we might fit.
Do these show up on credit reports? So I'm thinking about the ability for someone to go out and get a loan. How do they represent the fact that here's their net worth to a lender? I don't know that somebody would say, okay, I'm going to establish a reverse mortgage, and then I'm going to go get a loan somewhere. They've already got access to money through their home, but does it show up on a credit report?
Yeah, it would show up in a credit report. However, most other lenders, and certainly us as well, there's a big differentiation between secured debt that's secured to an asset like a house and unsecured debt. So the one that affects credit rating more is unsecured debt. So if you find somebody servicing unsecured credit card debt, for example, often I get the question, I'll answer in a different way. Is they say, we have a line of credit. We understand we have to pay that off, $200,000, but we also have $80,000 worth of credit card bills outstanding. And I'm like, well, naturally, we should probably pay them both off because you're going to get a better deal, if you may. But often is the circumstances, we don't automatically say you must pay off that credit card bill because it's unsecured. It's got nothing to do with the house. So when a reverse mortgage is on a house, it really has nothing to do with their ability to, perhaps get another credit card, increase their, balances, other things, businesses. It's unrelated because it's specifically tied to the house. People ask how much might I qualify for? And there's a calculator that I can take anybody, if they want to contact me, we'll have contact details later, but I can walk you through an illustration, calculate your own number, if you may. But often people have, significant rural properties like hobby farms and whatnot, and maybe
Right.
they're on the edge of the town, and maybe somebody's come along and offered them millions of dollars to take it over because they want to put in a subdivision or whatever it is. When a bank lends money, it's based on the value of that property as a home, not on the development potential of that. So a reverse mortgage, sadly, is not a good fit for somebody that is counting on the fact that their property is worth $8 million, but the house that they live in is like an old farmhouse. With that's
Right.
really what we take into consideration is a limited amount of acreage around the existing house and look at it as a home. As opposed to the future development potential that is somebody else's business. So, often we find that as a limiting factor where we're not a good fit. Well, we talked about the great divorce. One of the things that we have found is the value in keeping accounts intact. Meaning, when a typical divorce happens amongst older couples, usually there's an automatic redemption of everything. Not only is there a sale of a house, there's a sale of investments and so on and so forth. And then big tax bills that have to, and usually two relatively unhappy people. So, not that this situation can always be considered or make it happy, but it could be made happier. And one of the expertise that Home Equity Bank brings to the table, and I should mention this, is when a reverse mortgage is done, our clients must meet independently with a lawyer. So it's not just a representative from Home Equity Bank. It's not their advisor. They actually must sit down with their lawyer in order to sign the paperwork. So in a gray divorce scenario, it is interesting that often they're already in the works with a lawyer. Well, that's fine, because what we do is we harmonize our independent legal advice requirement with the final sign off of a separation or divorce decree. And that's actually when the land title is changed on a home. So it's not easy, but it's something that we do every day. And a lot of lenders aren't prepared to really jump into those scenarios. And we are, because we know that that's our bread and butter. And relating to that, it's an interesting topic, David, is power of attorney, right? So, when we write up our will, we have a contingent POA usually set up that, should something happen to me, I'll have a POA. So that's not what I'm talking about. I'm talking about a POA that has gone active. As an example, in the market I serve, I'm dealing with a 92-year-old, lovely person, but she has already passed POA to two daughters, and that's great. So usually when banks hear there's a POA looking for credit, they'll essentially say, no, we don't do that. Again, our major market is this better generation. So we, very, very emboldenedly delve in and do a very significant amount of work with active POAs. And this might be for healthcare. It might be, to improve the house. The biggest renovations, the two biggest renovations recently have been the ground floor washroom and the elevator and an elevator. This is sort of really, really fun. I've seen several, and you would never think that some of these homes have an elevator in them, but it's. But you point out an example that's happening more and more in metro markets is multiple generations in the same house.
Yes.
You might be surprised to learn that a reverse mortgage can be tailored, assuming that two individuals are of the age that qualify for. So think of a widowed individual, and they have their single son or daughter in the home, and they want to get the son and daughter onto title of the home. Well, if they are over the age of 55, we can actually underwrite a reverse mortgage in both of their names. So then in the event that the older generation passes and the home passes to the younger generation that occupies the home, that the reverse mortgage just continues. And this is becoming more typical in metro markets, but really fascinating stuff.
Well, it's actually very common, because you end up getting the 70-ish, 80-ish widow that doesn't want to leave their home. And what I've seen is where the 55, 60-year-old son or daughter sells their home and moves in with the mother
to take care of them. Yeah.
Yeah, it's a very common occurrence.
Sure.
So
Yeah.
I just like the flexibility that this
Yeah,
works
yeah,
very
yeah.
well.
Yeah, you know what we can talk about a little bit is cottages. This
Okay.
is another thing. You were talking about great divorce, but you know one of the things that you know, when the property markets have come down 18%, perhaps in the
Hmm.
major metropolitan Canadian marketplaces, the cottage country, or in our West Coast viewers, the cabin country, I guess, you know, comes down. It's come down disproportionately more. So, you know, many people are viewing this as the opportunity to, as a launch pad to buy or acquire cottage property. You know,
Yes.
and you know, I was involved in a case with an individual that you know, had their eye on a property that was worth $1.3 million, but not anymore because it's come down to less than $1 million. So, you know, this is a point in time opportunity from a real estate standpoint for people to buy. And yeah, the primary residence, yeah, might have come down a little bit, but it might have freed up enough cash flow for, let's say, a high net worth individual in order to just buy that cottage outright and live that dream. You know, not to add any degree of complexity onto that, but interestingly, a reverse mortgage can also be what we call blanketed onto multiple properties, using the primary residence as a base for the reverse mortgage. If you have a separate property that qualifies as a home, so let's not call it a cottage anymore, let's call it a second home,
Hmm.
they can actually bring a portion of the value of that second home into the equation into one complete chip reverse mortgage. And the benefit of doing that, of course, is that you have even a larger amount of money
Right.
available. So whether you're going to acquire a property, if you do that, it actually brings an additional option to bring in the future an additional property into the deal. This can be multiple properties. We have situations, in example, in Toronto with people that have relatively low income, but they seem to own every house on the street.
Yeah.
Yeah, it happens, and you know, this limited income prevents them from going to a conventional bank and saying, you know, my $50,000 a year income, I own $8 million worth of real estate. But you know, that's not the way that a conventional bank looks at it. Well, a reverse mortgage doesn't look at it that way. We look at it as the value of the primary residence. Oh, you have another property, we can blanket it in. You have another property, we can blanket that in. So you know, that might be the acquisition of house number 9 on the street type of thing, but it is possible, and we've been involved in some of these.
I just look at it from, especially if you are interested. One of the things that I talk about in many of the videos is that many people, when they retire, they stop thinking about making money. They're like, my working years are over. I've got this savings. That's it. I'm just going to live off of what I've got. And I said, no, like, you have opportunities to make more money. And so you just bring up this idea that you could use a reverse mortgage, not have to make any payments. So you could go out and acquire another property with that money, generate some rental income. Or even if you're interested in flipping homes and going in and buying a property and renovating it and then selling it, that money is coming from your principal residence through your reverse mortgage that it hasn't encumbered you in terms of cash flow, because you're not having to make any payments. And then you could just simply sell that investment property and pay off the reverse mortgage.
For sure. For
And
sure.
it still leaves, let's say if you qualified for $500,000, when you pay off the loan, the reverse mortgage loan, does it close that, or is it just a zero balance at that point?
It does. It closes it. So from that standpoint, it's not like a home equity line of credit. It's essentially a payment. So there's some base level benefits from a payment standpoint. A client can pay the monthly interest cost of a reverse mortgage, no problem. They can tailor it to $100 a month, $200, all the way to the monthly cost of the interest. On the anniversary of a reverse mortgage, the client has a right to pay down 10% of the outstanding principal on outstanding balance on the reverse mortgage. But it also simultaneously reduces the ability for somebody to ask for that money back. And after a 5-year period of time of having a reverse mortgage, there's no obligation that person can pay off their reverse mortgage in its entirety. So you know, we have certain different versions of chip reverse mortgage flavors, if you may, that we can actually customize for particular client needs. One of the bigger ones right now is somebody that does have a very valuable property in a major metro marketplace, but they want to acquire a property. I don't know, I'm thinking of development in Bracebridge, Ontario, that still is $1 million, right? But it's beautiful, and it's close to a hospital up there. They're familiar with the area, but they're sitting on a multi-million-dollar property in the city. Like, where are they going to get the funds to fund the construction of that home, right? So what we find is a chip reverse mortgage is a very valuable vehicle for that phased need for cash to buy that second home, and then eventually the primary residence is sold and they move and they pay off their chip reverse mortgage. More times than not, they come back and they put a reverse mortgage on the new property, right? So it's a really, really fascinating business that I'm in, and we get to see all sorts of circumstances. We just want to make sure we tailor the right solution. This is a live example of somebody in Ontario that had a very expensive house. I believe it was worth almost $2.5 million in Acton. This is the most beautiful thing about being across a table with a family. Here was this family's challenge is during COVID, this gentleman, Brian, changed the names here to protect our clients, but Brian Campbell, had a condominium in Florida. And the problem was during COVID, all his family, his grandchildren, could not travel to come see him in Florida. He went down and invested the time and money to be there, but the sort of casual travel back and forth that used to happen in the old days wasn't possible. And Brian always had this example in his mind: wouldn't it be great to own a cottage? And in the scenario which I already introduced a little bit, we had a very significant drop in the cottage country properties valuations, and on the north shore of Lake Erie, acquired a property that used to be listed for 1.3 or so, down for just under $1 million. And and he used the power of the value of his home in Acton in order to do that, with room to spare. And in fact, this gentleman had additional money left over, chip reverse mortgage room, if you may, for perhaps he has an initial renovation on that cottage that he has in mind. But, interestingly, once that property is acquired and a little bit of time marches by, let's say 2, 3, 5 years, whatever the case is, if there still is a need for additional money, then he may contemplate and would have an option to now take the value of his primary residence and then add in it his second residence, his second home, I'm going to call it, and see if the numbers where it makes sense in order for him to build an even bigger buffer. And this makes a lot of sense right now for somebody to execute this, because in a way, the bigger issue is the value of cottage country property has come down. Interest rates are higher, but what's the future going to hold in 3, 4, 5 years? I can assure you that we're likely going to anticipate higher real estate values, just the way things go. So if you can execute a point in time thing to acquire that property and then reevaluate your circumstance in 4 or 5 years or whatever it is, you may have this important option in order. The rich get richer. Really, that's
well, I mean, he's house rich, right? He's been able to have as many people in British Columbia have seen the benefit of their homes going up in value. So you're just taking advantage of an asset class that you otherwise would have had to sell.
Well, here's another interesting thing I'll add to it is, we have to be experts at Home Equity Bank on the real estate market as well. So we're constantly looking at various markets, like, for example, north of the city, places like Orillia, Innisfil, Barrie area, even looking further north, there's been big transitions in populations that way. So we're constantly looking at the real estate values, and you may be surprised that some of the more active markets for reverse mortgages are outside of what the typical Toronto, they could be extended, down to Fort Erie type of circumstance. It's a really, really, we have a tendency to follow the real estate market quite closely, and increasing value is made available to those people that used to be considered in rural areas. It's fascinating.
I think the next slide you had was about healthcare.
Yeah. Yeah, and we touched on one of these things, and the big thing is that to realize the cost of it. You know, this is where the job becomes a little bit more emotional because you're talking to families, and sometimes there's been a pledge. Somebody has basically told mom or dad that you're going to stay in the house no matter what.
Right.
You're going to stay, and the cost of this is can be really really astounding for full-time nursing care. And there's services all over that provide this, but you may not be surprised to learn that the bill for these services $80,000-$90,000 a year, sometimes even higher, depending on the level of care. And if there's been a commitment that mom and dad stay in the house, where is the source of money going to come? So if the next generation, as an example, that will inherit the real estate is wrestling with a concept where one child has the means to pay for mom and dad's healthcare, but the other one does not, well, in the eventual estate position, how are they going to reconcile the cost of that? Heck, I invested or paid $120,000 for healthcare for mom and dad. You didn't pay anything. You visited a lot, but how is that going to be equalized in the eventual distribution of an estate?
Right.
It's a very, very tough question, and because once somebody is under the control of a POA, it's not possible to change the distribution of how an estate is divided. So, the better solution may be to put the financial obligation of a debt like a chip reverse mortgage in the name of the person under care, so that when the estate is eventually settled, it's settled on a net basis for an equalization of the distribution of the real estate net of paying off the cost of the reverse mortgage. One area that we should really cover is, when does a reverse mortgage become due? A reverse mortgage does not have a term. It is as long as one or the other spouse remains in the home. So, we have circumstances where we have clients in excess of 20 years with us right now, where they remain in the house. But a reverse mortgage becomes due when the last spouse no longer occupies the home. And in the event of death, right, of course, we're experts at dealing with estates, right? So there may be probate necessary, as long as we're in constant communication to find out what the estate intends to do. We do not own the house. We are just simply a mortgage charge like any other debt on the house. So as long as we have confidence that we're working with the estate towards a resolution of our debt, for example, maybe one of the children wants to occupy mom and dad's old house. Well, we will eventually allow them to take title of the home when they pay us off. And normally that gives them the breathing room to organize conventional financing elsewhere. Or heck, maybe they're old enough and they qualify for a reverse mortgage and they want to do the same deal that mom and dad did. Like that's possible. So, we want to make sure that we have all the flexibility of dealing with that. And it works out really, really well, really, really well.
One of the areas that I thought was interesting, being an insurance advisor, but certainly maintaining life insurance. Are you really speaking about this idea of making sure that they keep their insurance in force by using the reverse mortgage to pay for the premiums? Is that what?
Yeah, it's we don't have to go into the depths of the detail, but that's exactly the concept. See, the insurance policies that are offered now are not like the ones they offered back in the day. They get increasingly more difficult to qualify for and whatnot. And, sometimes the burden of the cash flow necessary to maintain premiums or to max fund some insurance policies is such a cash flow burden on somebody that has gone into retirement. They have limited cash flow to pay it. There might be a tendency to cash out the policy that might not be in the best interest of the estate. So, reverse mortgage funds can be redirected to pay the premiums on an existing policy, because a new policy is either not possible to be purchased, or just it's better to have the old policy. So most certainly any insurance professionals that we deal with is, don't cash out until you don't allow the client to lapse a policy until you consider the reverse mortgage to fund it. And it is a good solid idea, especially when there's a potential to max fund it and to have maximum benefit to the total estate. We're just a source of cash flow, really.
Right. So the client doesn't necessarily have to do a downsizing event in order to continue to find or
Exactly.
even start a new policy,
Exactly.
they can actually just dip into a reverse mortgage. That makes sense. It's
Yeah, yeah,
practical.
and you know we've worked on several of these, and you know we've worked with a you know insurance professional to show the you know how to maximize the value of the estate. Sometimes if you do the modeling, the reverse mortgage is not the solution, and you know we have the horsepower you know with our planning tools to be able to sort of say yes we can actually fit it very well in here, or we don't fit, right? It's we like to be as objective as possible.
So one of the things I want to put up here right away is your contact information, because so part 2 of our discussion is going to talk about business owners. So I want people to be able to know how to get in contact with Andrew with Home
Yeah,
Equity Bank.
yeah.
Again, full disclosure, this is something that I would send my clients to. I have no compensation around the area of this video at all. This is about trying to help people by giving them more options to just understand, hey, that you're sitting in a place, you're going to bed every night
Hmm.
in an asset that could be very useful for you.
Yeah.
And so, Andrew, I appreciate do you have any final thoughts on reverse mortgages just for individuals before we jump into business owners?
Yeah, you know, like the reverse mortgage is actually a very simple concept. Its application within your family could be more complicated. You're going to get the best service through a professional advisor, and that's the marketplace that we serve. And most certainly, a first step might be contacting me with that contact information that you maybe put up again, and I can have
There you go.
yeah, I can have a casual conversation with you about your circumstance and better understand where it might fit, and tell you if it's a good fit, where maybe that's not the best idea, and then make sure that you have a quotation. That's the most important thing. It's like, how much does mom and dad qualify for? How much do I qualify for? Whatever the case is, we have the tools to be able to do that rather quickly, and you want to be in touch with me directly in order to get that information.
Fantastic. Thanks, Andrew, for all your help today and being able to explain what has been sort of a very complicated and also, I don't think, a very well understood product. And you've, I think, opened up a lot of eyes. I think a lot of people who are going to see this on my channel are going to see this as an opportunity, not as a lifesaver, but more also of an opportunity to really enhance their own financial well-being. So thanks very much for taking the time today.
Thank you, David.
We're going to dig into, so anybody who wants to stick around, we're going to dig into part 2, and we're going to be talking about reverse mortgage for business owners. Thanks very much for joining us today, and we look forward to seeing you in the next video. Take care.